Hi, I'm Jesse Jones, founder of Fourscore Business Law. Thanks for tuning into this quick video on convertible notes. In this video, we're going to cover four things about convertible notes. One, valuation, discount on conversion, valuation cap, and the interest rate. First of all, valuation. So valuation is one of the major negotiating points in any deal. And one of the major reasons that people use convertible notes instead of preferred stock, is that question of valuation, that negotiation, can be kicked down the road to a later date. That makes convertible note financings a lot faster and a lot cheaper, which is really, really helpful, especially at an early stage. So most often you'll see convertible note deals done as maybe the first money in, the first financing that the company does, or potentially between equity rounds. But it's a great reason to use convertible notes because you don't have to deal with the valuation question. Now, the discount on conversion. So the way that a convertible note works is the investor puts money in. It's technically debt, and the company issues a note to the investor. However, all the parties understand that the note is really not intended to be repaid. The intention is for the company to raise more money later and then take that debt and convert it into equity in the next round. So the discount on conversion is there, and it's typically somewhere between 10 and 30%. Most often, I probably say about 20%. And what that means is that when the company negotiates with the next investors what the share price is going to be, the note that the investor buys is going to convert into those shares at a discount, at the 20% discount. So if it was $1, it'd be roughly 80 cents would be the conversion price for the notes. That's there really to compensate that early investor for putting their money at risk sooner than the rest of the investors that come in at the later financing. The valuation cap is a very important piece of a note. From the entrepreneur's standpoint, you want to sort of avoid the valuation cap or push it higher. From the investor standpoint, they want it to be low, but hopefully everybody's just acting reasonably. But basically what that says is, yes, investor, note holder, you're going to get a discount on the share price that we sell in the next round. But the investor wants a little bit more comfort that you don't have some rich uncle that doesn't really care what valuation you put on the company, and you go raise $100,000 at a $100 million valuation, which would convert their notes into an extremely small percentage of ownership of the company. So the valuation cap says, okay, you're going to get your discount, but in no event are we going to use a value of the company higher than X to convert your notes. It gives that investor just a little bit more comfort. And then the interest rate, it's there. It is debt, so it's very normal that there's going to be an interest rate on the convertible notes. However, it's usually relatively low, somewhere between, I don't know, maybe 3 and 8% is probably normal. That's not normally a big negotiating point, but it is part of every deal. For more information on convertible securities and convertible notes, please check out our venture white paper on fourscorelaw.com. Thanks very much.